Okay, I believe we're live. Let me just check and make sure everything is working properly. Testing, testing. All right, can everybody hear me? I can hear me. I think that means it's working. One viewer, but no comments yet. Please let me know in the comments if something is wrong with the sound. Too loud, not loud enough, quality good, quality bad. You know. Okay, we're just getting situated here. Okay, I think we're good. Okay. Okay. And we're about to get started. Just get some stuff figured out really quick. What y'all's plan? Okay. 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 Tommy Shelby, what's up, man? I haven't seen Okaje yet. Yeah, we started 15 minutes early, so he's probably just taking a minute to come on in. I'm doing well. How are you doing? Today we are looking at value companies per usual. And, you know, I'm just going to go ahead and get right into it. So, question is value investing dead? So, of late, we have seen growth companies outperform value. On this graph right here, titled The Unprecedented Outperformance of Growth Over Value, we can see going back to 1936, value has reigned supreme. However, lately, we have seen growth companies just crushing it. I'm talking about the Magnificent Seven, and now I guess we could call it the Magnificent Eight, as Broadcom has found its way up above Tesla. And I actually haven't checked it in the last few days, so maybe they're bouncing back and forth a little bit. But growth has been outperforming like crazy, and a big part of this is the fact that we've been in a bull market for so long. During COVID, yes, we had a very, very short bear market, and in 2022, we had a very short, a two-quarter recession, only technically a recession, but the stock market went down just a little bit, immediately recovered. We're constantly hitting all-time highs. So yes, growth has, as an index, outperformed value, but overall, investing in value companies is still a winning strategy. And I want to make the case for that in this video. And one of the key features that I look for when I'm investing in a value company is a MOAT. Hokage, how's it going? I'm glad you could make it in. on a Costco run. Very nice. Costco, hey, that's exactly what I'm talking about. That is a company with a super strong moat. But the company that I'm going to be looking at today is Deckers Outdoors. This is a company, I would say the two brands that this company is known for the most is Uggs and Hokas. And I actually have a pair of Hokas just recently. I just got on the bandwagon. Love them, super comfortable. This is a company that has a moat because they have a very strong brand. People love the Uggs brand. People love the Hokas brand. I wouldn't call it like necessarily a super wide moat, but a brand strength moat nonetheless. And what a moat does for a company is it gives them a strong competitive advantage, a durable competitive advantage. And one way we can see this manifest is in the financials of Deckers. So we can see that they have consistently had very strong revenue growth since 2020, 19% revenue growth, 23% revenue growth, 15, 18, 16 in 2025. Incredibly fast growing company. So even though as an index, growth has outperformed, that doesn't mean that individual instances of the strongest value companies are not going to do incredibly well over time, especially since we are in a very, very long bull market right now. So growth companies are outperforming when the economy is in a good position for companies to grow. But the moment we have a pullback in economic activity, all of the growth that was priced into all of these super strong growth companies is going to bring their stock price down, because their stock price now is very high compared to their current earnings, because the market thinks we're going to have tons of revenue growth in the future, tons of earnings growth. And if that future doesn't happen, that's when we see share prices drop drastically. So hey, let me look at some of these comments. Have you seen the video by Andre J? I'm assuming that's Andre Geek about the AI bubble. No, I have not. As far as an AI bubble, it really is hard to say. A lot of companies are investing heavily in AI because the idea is it's going to bring a lot of productivity. It's going to bring a lot of revenue growth. And, it's hard for me to say if it's going to happen or not. I tend to invest in companies that have a margin of safety. So even if the super productive future doesn't happen, they're still priced low enough to where I'm likely to make money, or at least not lose very much money. So what I'm seeing is a lot of the AI companies are just priced for a perfect future. And so that's why I'm not saying that they're not going to do well in the next 5 years. They may do incredibly well, but if we have any kind of pullback, any kind of slowdown, then we're going to see a huge drop in share price. So that's my take on the AI bubble. At this point, I would say it's still difficult to say if we are actually in an AI bubble. It's just the best way, in my opinion, to handle it is to invest a small percentage in a diversified fund that gives you exposure to AI, like QQQ. For instance, I do hold QQQ in my personal holdings. This channel is mainly devoted to value investing, so I'm not investing in stuff like QQQ. I do have, I will scoop up Google and Meta when it's at a value price, but that I would say is the exception, not the rule. So a lot of these AI companies are hard to find at value prices. Anyway, okay. So yes, even though as an index growth has performed so much better, I still think that on an individual company basis, finding value stocks is still the way to go. It is the only way to have a margin of safety in your investing, is to have a value-oriented mindset. And one of the strongest features of a value company is the moat. Okay, so back to Deckers. Why do I like Deckers so much? Well, this company came on my radar about a week ago, and then unfortunately, I have not invested in them yet. I wish I would have now, but I typically like to invest after I have my stream on the company, and they have gone up 3% in the last 5 days. So, unfortunate, but they have had a big drop recently. A lot of it is around tariff concerns. A lot of it is around speculation that we might be coming into a recession or a market slowdown. But all that being said, no matter how much trouble there might be on the horizon, if the current stock price takes that into account enough, then it still can be a very good investment. And so that's what we're looking at right now. So Morningstar, this is one of my favorite tools lately. I have access to Morningstar's due diligence reports by analysts, and Morningstar currently rates this company as of recently a 4-star rating in terms of value. And one of the big takeaways right here that I want to look at right here, in the long run, we think Deckers can achieve sales growth in the mid to high single digits and operating margins around 20%, with minimal apparel sales and small global store bases, fewer than 50 for Hoka and 150 for UGG. We think the firm has expansion opportunities. So global expansion opportunities, and they believe mid to high single digits for sales growth. That's their total revenue growth. So that's one of the key factors I'm going to look at. I also want to go down to here. They also have a nice write-up on whether or not the company has a moat, which I always think is really interesting to read through. So Deckers right here, it says, we assign Deckers a narrow moat rating based on brand intangible asset. Founded in 1973, Deckers has bought and sold several footwear brands in its history. At present, the firm produces footwear and much smaller amounts of apparel and accessories under 4 brands: UGG, Hoka, Teva, and Anu. Our narrow moat rating is based on the brand value of UGG and Hoka, which account for more than 95% of sales and virtually all of their operating profit. So these are the 2 brands that we're mainly concerned with, and they are incredibly strong brands. And I can't really speak to UGGs, but personally, I am a huge fan of my Hoka shoes. So it is always a bonus to have experience with the company. Sorry, we have Alexa reminder set up. It is always a big bonus to actually have experience with the company that you're investing in. That way you can kind of keep an eye on if their quality is moving up or if it's going down. So anyway, Hoka, narrow moat, according to Morningstar. I also want to look at their profitability going forward, according to the Morningstar analysts. Down here we have a table. So right here is where they show their past 3 years metrics. We've got revenue growth, operating margin, EBITDA, net margin, free cash flow to the firm. So revenue growth right here. So Morningstar is predicting 9%. They said mid to high single digits. That's over the next 5 years. In terms of their operating margin, we're seeing a small pullback in operating margin from the 2025 level. So they're kind of averaging out around 20% operating margin. So I also want to keep that into account. So I've got two tools that I really like to use when I'm using my discounted future free cash flow intrinsic value spreadsheet. Sorry. This is my automated spreadsheet where I calculate the intrinsic value, my estimated intrinsic value of a company using the discounted future free cash flow model. There are 2 components to that estimate. Number 1, future revenue growth projections. I get that from the analysts. And then number 2, what is their profitability going to be? So I look at 2 primary stories that I want to tell myself about the future of the company. Number 1, where are they at right now and what has their recent past looked like? So if they are able to continue with their past performance, what does that tell me about their share price today? Now, of course, past performance is no guarantee of future performance. People love to say that. However, a company that has previously done well is more likely to do well in the future than a company that has not done well in the past. So no, past performance is no guarantee, but it is a strong indicator. Okay. So in the past, we have seen, this is according to the past 5 years, we have seen 15% revenue growth. Their average free cash flow margin over the last 5 years, this is the percentage of their revenue that they have been able to turn into free cash flow, has been 16%. And if they're able to continue that trend going forward for the next 5 years, and then we see, sorry, I've got some of these figures messed up. Okay, so right now on my prediction, I'm assuming 3% revenue growth for years 1 through 5, 3% revenue growth for years 6 through 10, and then 3% perpetual growth rate. So if they're able to achieve 14% revenue growth over years 1 through 5, that's their past revenue growth over the past 5 years. And then if that revenue growth slows down to 7%, I usually just assume it reduces by half, just to be conservative, for years 6 through 10, and then they achieve a perpetual growth rate of 3%. This is somewhere between inflation and GDP growth. Inflation is usually averaging somewhere between 2 and 3. GDP growth is generally averaging between 3 and 4. So just as a conservative estimate, or maybe not super conservative, but just a fair estimate for perpetual growth rate, 3%, roughly equal to inflation. So if that is the case, then their fair share price today would be $203 per share, which represents a 141% upside. And that is assuming that I want an 8.21% return per year every year. So just so everybody's clear, this discount rate right here, this is a very important piece of the puzzle. So this calculated intrinsic value, this is what I would be happy buying the shares at today if I was just wanting an 8% return going forward. So $203 buying it today gives me a 8.21% return. However, the current share price of Deckers is $84.10. So we're buying it well below the projected intrinsic value based on their past performance. So this is the margin of safety that I have according to past performance. The second way I like to value companies is I like to look at the projected future performance. So according to Morningstar, they are saying somewhere between 5 and 9%. We'll just go with the more conservative end. We'll say 5% revenue growth for years 1 through 5. We'll say 5% revenue growth for years 6 through 10. And then we'll make this a little bit more conservative. We'll say a 2% perpetual growth rate. With Morningstar's extra conservative, the conservative side of Morningstar's projections, this is now calculated into my projection. Now I'm having a fair share price of 117, representing a 40% upside. So according to past performance, if they're able to perform as well as they have in the past, we have a massive upside of, I think it was 140%. If they're able to perform, I would say roughly lower than what Morningstar projects, then we're having a 40% upside. So based on future projections and based on past performance, I'm seeing a sizable margin of safety with this company. So that's two kind of ways for me to visualize if a company is trading at a discount. The third way, I said there was only 2 ways. There's actually 3. The third method that I like to do is I like to invert my thinking. I want to put in the assumptions in place that make this company a fair share price today. So basically, what does the market believe is going to happen to justify today's current share price? And to do that, I went ahead and calculated it. Assuming they continue with their average profitability, but their revenue slows way down. So I'm going to approach this from 2 different ways. Either profitability stays roughly the same and revenue slows way down, or profitability slows down and revenue slows down as well. So those are the 2 ways I'm looking at this. So, okay, my projection is now 0% upside. So according to these assumptions now, the current share price is fair today. So if we assume that their profitability stays the same, their revenue growth over the next 5 years is 3% instead of Morningstar's projected 9, instead of their past revenue growth of 14 on average, just 3%, super low. The next 5 years after that, they only have a revenue growth of 1.5%. And then the perpetual revenue growth rate is now 0. So they basically, their revenue growth basically halts over the next 10 years. It just starts hemorrhaging down, slowing down until they have no more revenue growth at all. That would mean that they are fairly priced today if I want a discount rate of 8.21%. So I should be able to achieve 8% returns every year forever with this set of assumptions. So essentially, to me, this looks like an unreasonably bearish set of assumptions. I just don't see Deckers halting their revenue growth over the next 10 years and then never growing again. I just don't see that as a plausible situation. So this final kind of way of looking at things gives me even more confidence in my margin of safety that I have, that I see with the analyst projections. And then one last set of assumptions I want to look at. If their profitability drops down to 12%, then we would need to see just 3% revenue growth. So that would be my projection of $86 per share. That's a 2% upside. So if they're, let's see, what percentage would that be? That would be like a 25% reduction in free cash flow margin going forward forever. And then they're only able to increase their revenues by 3%, roughly equal to inflation every year forever. Then the current share price today would be a fair share price. So once again, even if they lose some of their profitability, I still think their long-term revenue growth projection is going to be greater than 3%. So to me, Deckers has a huge margin of safety. And one final look, I want to see the average analyst assumptions, not just Morningstar. Morningstar is just one group that puts out projections. If I go to stockanalysis.com, here's where they pull together many different revenue projections. So in this case, 26 analysts for 2026, 29 analysts for 2027 projections, 12, 5. So it does drop off as you go further and further out in time. But we have, an average revenue projection right here that I also like to use. So if I copy this data right here, So yeah, here we can see the upper end is high teens, the average, and this is in line with their past revenue growth. The average is between 5 and 9, which is pretty much in line with Morningstar. And then the lowest analyst projections over the next 5 years are showing a little bit of revenue decline. So let's use these projections. We'll copy that, paste this into my spreadsheet. Okay. And now if I assume 3, 3, and 3, so for years 1 through 5, I've got the analyst assumptions that I just pasted in. For years 6 through 10, I'm assuming 3%. For the perpetual growth rate, I'm assuming 3%. And now here is the spread of intrinsic values. So if the most bearish analysts are correct, then I'm not going to quite get my 8.21% per year. I'm buying it currently 12% too high because the fair share price would be 74. So I would be missing out on a little bit right here. But if the average analyst is correct, then I have a 25% upside. If the highest analyst is correct, then I have a 76% upside. And that's this is with the lower profitability. If I bring their profitability back up to where it is over the average for the last 5 years, now even the lowest analyst projections put me at a 15% upside. And now the highest analysts have me at a 133% upside. So based on all this, Deckers looks to be like a really strong value play, especially having a moat. And one more case for this company having a strong moat. Warren Buffett has several financial metrics and ratios that he looks for in the cash flow statement, the balance sheet, and the income statement. And I have those automatically calculated right here. If a cell is highlighted green, it's a green flag. If it's highlighted red, then it's a red flag. Too many red flags, and I will generally pass up on a company because that requires a lot more research. If there's red flags, you have to actually look and see, like, okay, it's a red flag, but is it actually something that is going to bring concern? But with Deckers, I'm seeing nothing but green flags. There are no cells highlighted red. And just to quickly run through these, Warren Buffett likes to see gross margins above 40%. Selling, general, and administrative costs, he wants to see low. Ideally, it would be under 30%, but anything over 80 would be a red flag. R&D, he likes to see as low as possible, as close to 0 as possible. 2% is a green flag. Interest percentage, Your interest payment as a percentage of your operating income, obviously as low as possible. So this company has almost no debt, making it even less risky. And then a profit margin above 20% would be a green flag. And we can see that Deckers is on the upper end of neutral, but getting close to a green flag. Profit has gone up every year. Earnings per share has gone up every year. Profit and inventories are going up together, which is a good sign. Retained earnings is consistently going up. Cash is going up while debt is remaining flat. Goodwill is remaining flat. If goodwill was dropping, that would be a red flag. Capital expenditures, incredibly low, green flag. Depreciation, very low. And adjusted current ratio, very high, meaning they have plenty of short-term liquidity. Operating cash flow has been trending up, and they've been buying back shares, which is a green flag. I like to see their shares outstanding going down. So nothing but green flags, meaning this is very strong evidence that they have a durable competitive advantage. Morningstars agree that they have a narrow moat. According to the discounted future free cash flow analysis, they seem to have a sizable margin of safety. So this week, I'm investing $100 into Deckers. Generally, I invest $100 every week. This is my public portfolio YouTube series where I'm focusing primarily on value companies based on the discounted future free cash flow method of analyzing a security. So that's not to say I'm only going after companies that are incredibly cheap. Some of the companies I'm going after are high growth companies. There just has to be a strong margin of safety below what the analysts believe is going to happen. So yeah, super strong company right here. Let me check out. I haven't looked at comments in a while. I apologize, y'all. Let's see. Hokage says there could be a pullback because of the circular economy. What is worrying is so many people staying cash lately. Warren Buffett, SoftBank selling its stack in Nvidia. Yeah, I haven't looked into Warren Buffett's cash holdings in a while. Generally, I think that gets overblown a lot. I'm not saying it's being overblown in this case. I haven't looked into it, but what tends to happen is it gets overblown because for his insurance businesses, he's required to hold tons of cash. And so if you look at what he's required to hold, his actual cash holding typically doesn't fluctuate too much above that amount. Maybe it has lately. Hokage says, based on a quick look, charts say it is at the bottom of a drop. Worst case, it could hit 70 before a reversal, which is likely only if a bear market happens, in my opinion. That's for stock ticker Decker. Okay. So yeah, Hokage throwing in a little bit of technical analysis. Very nice. That's a good sign. Hey, if the chart looks good according to technical analysis, I see that as a bonus. Nothing wrong with that. So yeah, I really like Deckers. Another company I want to bring up is a strong moat company, or a wide moat company, according to Morningstar. I'm talking about Airbnb. So recently, Morningstar is also giving this company a 4 stars out of 5. A wide moat rating. Let me scroll down a bit. Y'all heading out? All right, have fun. Okay. Where was I? Okay, we assign Airbnb a Morningstar economic moat rating of wide based on our view that the company will successfully expand internationally in its core vacation rental market and augment its position with a leading experiences and service offering. So with Airbnb, especially because they are the most widespread in the market, it creates a feedback loop where people want to do business more with Airbnb because they have more options. If you want to put your own house up as a rental, you definitely want to put it up on Airbnb because that's where that is the company that's getting the most traffic, giving you the best chances of having somebody stay in your house. So Airbnb just has this huge like first mover advantage where they've just snowballed this advantage, and now they are the primary source for vacation rentals if you want to stay in somebody's house or if you want to put your house up for rent. And yes, I do believe we already bought Airbnb. Let me see. Oops. I got to get this logged back in. Bear with me and I'll pull up my portfolio. But just in the spirit of looking at wide moat companies, Airbnb came to mind. I saw the report on Morningstar, and so I just wanted to bring up another example of a wide moat company. So let's see. Let's pull it up here. YouTube. Okay, here is the YouTube portfolio. Oops. Okay. We are at $5,743 invested. Let me filter these by company. I believe Airbnb has gone down a bit lately, if I'm not mistaken. Yeah, Airbnb. So since we bought, it's down about 10%, almost 11%. So in my mind, this company is looking even more attractive. And I want to also show that on our valuation spreadsheet here, Airbnb. So their historic free cash flow margin over the last 5 years has been 27.26. However, I tend to look at my own calculation down here because I take into account I take into account stock-based compensation, and this is something else I'm going to highlight in this live stream, like how horrible stock-based compensation can be, and it gets missed a lot of times when people are doing free cash flow analysis. So in 2020, I'm going to exclude this year. This is destroying the average. It's really bad. If I just average these four, we're looking at about 30%. So, I will go ahead and just use 27 to be a little bit more conservative. So 27%. Hokage says also, Akame had good news recently and has recovered beautifully. Good value pick. I had got it at 76. Nice. Yeah, I was so happy to see that because Akame, yeah, it was struggling for so long. And yeah, we knew that it was a good value pick, had a sizable margin of safety. And so when you see some good news finally in a company like that has a huge margin of safety, that's when you see that recovery back up to fair value. So yeah, now up 5%. This was a company that was down, man, where were we down? Were we down like 30% at one point with Akame? But yeah, we held through it because the intrinsic value calculation still shows that it's undervalued. So that is the way I do things. Yeah. And then Nice as well. I think I haven't looked at this company in a while, but this is one that I had doubled down on. It's been down quite a bit, but I think it's a really strong company. Anyway, we'll look at some of these companies that are losing in a little bit. I still want to do Airbnb really quick. Okay. So according to Morningstar, oh, and you know what? Actually, let's look at the stock-based compensation. Like while I bring that up, let me just pull that up. So on the cash flow statement, stock-based compensation. So the way free cash flow is calculated is you start with operating cash flow and then you subtract capital expenditures, which they don't have any capital expenditures. But the way that they got to this 4.5 billion in operating cash flow is they took their net income and then they added back in expenses that are non-cash expenses. And this big one right here, stock-based compensation, 1.5 billion. Yes, that's technically a non-cash expense because they are giving they're giving stock to employees. They're not giving cash to employees, giving stock. However, this company, if we scroll down a bit more, this company turns right back around. Where is it? Right here. And repurchases the stock. So right here, $4.7 billion in stock purchases. So I personally count almost 100% of this against their free cash flow. I take 95% of this out of the equation. And just to show why this is so bad, right here is the Vickers Insider Buying and Selling Report. Look at this. Almost 100% selling. All of the insiders, they're getting their stock-based compensation and they're turning around and they're selling it. So it's not good. It's not a good thing. I take almost all of it out of the free cash flow. And these are all, CTO, CFO, director, CFO, CTO, director. Yeah. These people are just, they're like these insiders are just, they're taking the shares and then they're selling them out. So, okay. Recently I found this website through a friend. This is from Hokage, where you can check the correlation between the stocks. I can share the link here. I can email you. Yeah, that would be nice. I would like to see that. Always a good idea to be mindful of correlations between your investments. A lot of times people can think that they're diversified, but if you're investing in things that are all very highly correlated together, then you don't really get much benefit of the diversification. So yeah, that would be helpful. But yeah, so in this case, all these insiders, they're just all selling. So that I'm counting that against Airbnb. So that is being factored into my analysis. Just let the record show. So let me scroll down on Morningstar. We can go to their long-term revenue growth projections on here. Let's see, where is it? Here we go. Okay, revenue growth. Morningstar projects 11%, and it is rising from 2025 through 2029. So it's 9% in 2025, and then it goes 11, 11, 12, 12 for an average of 11. So that's the average we're going to be going with for our for one of our projections here. And I would also like to point out that the operating margins, they are showing operating margins to be increasing. So we're seeing increasing profitability. To stay conservative, I'm not going to build in increasing profitability. I'm going to keep profitability where it is. But yeah, we can see here in 2025, it's at 21.7% and then growing all the way to 28.8 in 2029. So Morningstar projects increased growth and increased profitability out of this company, Airbnb. So, okay, 11%, that's what we said. Let me put that in. So my projection, 11%, perpetual growth rate, 3%. We'll say that they're in years 6 through 10, their growth gets cut in half. So we'll say 5.5. Based on these assumptions, first, according to their past performance. So in the past, they had 27% free cash flow margin. That's the same going forward. In the past, they grew at 27% every year. If they continue that trend for the next 5 years, and then their growth slows down to 5% revenue growth every year, followed by 3% into perpetuity, then we have a massive 136% buffer. So they have to perform, they don't have to perform nearly as well as they have in the past. So that's a really nice metric that I like to see. They don't have to perform well as they already have. Okay. According to Morningstar's future projections, 11% for 5 years, followed by 5.5 for 5 years, followed by 3%. That gives me a buffer of 32%. So if Morningstar is correct in their assessment, we have a 32% buffer on this holding. So what does it take? What does the market believe about this company? How much do I have to cut down their revenue growth for this to be at fair share price today? So if Airbnb only increases their revenue by 5% for the next 10 years, then they are at a fair share price today. So do I believe that? I think Airbnb is likely to exceed 5% revenue growth going forward. I think that's likely. Therefore, I believe this company has a margin of safety. Now, once again, let's look at an average analyst projection. So if I go to stockanalysis.com and look at the analyst projections here to see a range of projections, let's copy this. So the lowest analysts are putting it at 5, 2, 1, 1, and then -1. Let's paste this into our spreadsheet here. Okay. So based on those analyst projections, we're seeing the lowest analyst giving me a downside of 9% and the highest analyst giving me an upside of 76%. So average analyst giving me a buffer of 26%. So yes, my Airbnb holding, oh wait, that's my Schwab. Where is it? M1. So yes, Airbnb is currently down by, what was it down by? It's currently down by 10%. However, it still has, according to the latest projections, it still has a strong margin of safety, a minimal downside if the most bearish analysts are correct, and a sizable upside. And that, remember, this isn't just a 76% return. This is a 76% return on top of an 8.21% annual return every single year forever. Okay. Hokage said the stocks that have high positive correlation are not diversifying your portfolio. Yes, 100% agree. It just gives an appearance of diversification because people think that if they bought enough different stocks, they are automatically diversified. Yes, you are 100% correct. There is not a market diversification. You do still get a, what's it called? I believe it's called idiosyncratic diversification. Idiosyncratic risk is just like individual companies can have like individual bad things happen to them. Like, so for instance, let's say I only invested in Airbnb and then, for whatever reason, all of the governments in the world decided that we don't want to do we don't want people renting their houses out anymore. You know, something that just specifically like really hurts Airbnb. Or maybe a better example would be like their CEO or their CFO and their CEO have been cooking the books, you know, for the last 10 years, and none of their earnings are actually accurate, and they're actually making way less money. So you still do cut down on the idiosyncratic risk, but yeah, to your point, you want to make sure that you are not, you're taking advantage of diversifying your market risk or your sector risk, your industry risk, stuff like that. Anyway, okay, so that's two companies. I am not going to be doubling down on Airbnb this week. I'm still holding it. I just wanted to bring up a company. I wanted to have an example of a company that shows like a really strong moat and what that looks like, and how this strong moat is like a feedback loop for Airbnb. It's going to be really hard for competitors to overtake Airbnb just because they just have such a strong ecosystem right now where people want to do business with Airbnb because of their size. So it's like a self-fulfilling prophecy to some extent. So anyway, this week we are investing in Deckers. Deckers looks so good. Anyway, Hokage, Tommy Shelby, I'm not sure if you're still there, but if you guys have any companies that you want me to look at briefly, it's 8 o'clock. We still have 15, 20 minutes left on the stream. If you guys have some companies you want to look at, otherwise we can end it here and can prepare for the next stream, the next companies. I have a couple other companies that I'm really excited about that I'm saving for the next stream, so got to hold those back. But yes, indeed, some interesting. You know, I've had a few videos on this channel about investing in the cannabis sector, which I will bring up briefly because that's not what I'm doing my videos on. We have had some developments in the cannabis sector. Let's see, the company that I like the most. There's two companies, but if we're looking at a pure U.S. cannabis multi-state operator play, Green Thumb Industries is my go-to. So Green Thumb is at 7%. Hokage says, I do not have any because you have been finding some really good ones. Can't wait for Iridium and Simply Good Foods to recover. That's all. Yes, indeed. Those companies are just so down. Yeah, we looked at Simply Good Foods. We could go ahead and just check Iridium really quick and just see how it's looking. So according to past performance, first cannabis is not doing well because the government shutdown, which just reopened. Yes, and the big news that I'm like chasing butterflies here, getting sidetracked. I will just finish on that. The government it looks like they're going to close the hemp loophole. So in 2018, the Farm Bill opened up a loophole for intoxicating hemp products. It was meant for like to use hemp as like an industrial product, like a textile type situation, but people found that they could take hemp and synthesize some kind of synthetic THC that is intoxicating, just like THC is from cannabis. So anyway, this big loophole opened up. A lot of intoxicating hemp products that are unregulated, that have been flooding into the market, making it difficult for cannabis that is operating in legal states, because there's a lot of regulations that they have to follow, which makes it difficult to compete. So it appears that they're going to be closing the hemp loophole, which it sounds like is going to be good for cannabis. Ideally, I think they would just regulate hemp and cannabis together equally. That would probably be the best thing to do. But for now, it seems to be a good step in the right direction. So it does seem like we're getting some good news, some progress into cannabis. And I'm still waiting on Trump. He did say that he was looking at rescheduling cannabis. He said that he was planning on doing it. We'll see if he does it. Anyway, let's look at Iridium really quick. Iridium. Okay, according to their past free cash flow margin, taking into account their stock-based compensation, the average free cash flow margin over the last 5 years is 32%. However, more recently, they've dropped down to 29%. So let's just go with that. Let's be conservative. Let's drop them back down. Let's drop them down to 29%, even though their average has been 32.23. Okay. So if Iridium, with a 29% free cash flow margin, was hypothetically just growing at 2% per year forever, then they would have a 21% upside, a pretty nice buffer. If they grow based on their past revenue growth, then there is a 75% upside. If we give them credit for their past average free cash flow margin, then they're, according to their past performance, their upside is 103%. But let's just, for the sake of being conservative, drop them down to 29% profitability. So what is the market thinking about Iridium? If I put in, let's see, if I put in 2% and 1.5. Okay, so my projection, so fair share price today, the market is assuming 2% revenue growth over the next 5 years, 1.5% revenue growth for years 6 through 10, and then 1% for perpetual growth rate. So super, super, like not very good performance, despite having a massive 7% average past growth. So much higher in the past. This is what the market believes this company is going to do. So yeah, I just, to me, once again, I'm seeing a pretty nice margin of safety here. Let's look at what the analysts think, though, on the forecast tab. Okay, analyst projections as far as revenue growth. On average, they're putting it anywhere between, looks like 2 and 7 on the next 5 years. With that assumption in place, and if we make this, let's just go 3% across the board for our own projections. So the lowest analyst projections, the most bearish, would put us at a 3% loss. So roughly fair valued today, meaning we would essentially be getting our 8% return. So yeah, just let me just highlight that. This doesn't mean that we're never going to make money. This minus 3%. This means that we're just going to be getting slightly less than 8.21% per year every year. Not 3% less. This is our total buy-in price. So that would, what would our return be? Let me just see. If I make it 8, it would be more than 8. I got to just kind of do a guess and check. It would be basically 8.1%, right? That's what our return would be. Okay. Yeah, it was 8.21, right? So even though it says minus 3, that doesn't mean we're losing money. It just means we're only making 8.1% instead of 8.21. So that's the most base case. We're making money. The average analyst case puts us at an 84% buffer of safety. So really strong margin of safety. That is why I am staying in Iridium. Fair share price of $31 per share, according to the average analyst. When was the last time they were at $31 per share? I'm just curious. Never? Oh, no, this is day. Sorry, year. Looks like right about here when they started dropping off in July. Anyway, so yeah, still a solid margin of safety with Iridium, especially considering that they've dropped so much. So yeah, I'm going to be holding on Iridium. Okay, I think that's all I got, y'all. Thanks for tuning in. Appreciate it. As always, Hokage, appreciate you coming in and hanging out. Tommy Shelby, if you're still around, appreciate you, man. Next week, stream, it's going to be around this time, around 7:15 to 7:30. Got a couple companies that I'm really excited about, so I hope you guys tune in. Hope I see y'all then. Have a good night. Talk to you later. See ya.